Hey, good morning, everybody. I'm going to just start jumping right into this here. As always, we're grateful that you call in, and I know it's harvest. I know everybody's busy, and sometimes marketing is not the top of mind. But we're grateful that you're here, and I think we're going to have a great show today. I'm going to spend about 10 minutes, and I'm going to fly through our normal um, analysis real quick because we've got a special guest, and I'll give you just a little primer on that. Kevin Cantrell is dialed in, and he's going to give us an overview on an insurance product that I learned about yesterday, and he and I went through it. I think it's really innovative and something that you should be looking at because as we look at kind of the fundamental landscape for where we are today and where we may go into the future, one of the big questions everybody has on their mind is what about inputs? We've seen the cost of corn production for 2022 increase between 20-25% over the cost for 2021, and beans are only up about 5%. So you've got this big debate starting to swirl about should we plant more beans or what should we do? And so the market's got to digest that and figure it out. And it's, as most of you know, it's really hard to manage that fertilizer, that input equation, because there's not a liquid futures market. It's much more difficult to manage it. So this insurance product helps with that just a little bit. So we'll get to that here in just a minute. I think in about 10 minutes, I'll turn that over to Kevin and we'll go through it. Other things that are happening fundamentally and aren't a lot different than last week, except for yesterday, we saw the dollar really break out to the high side. And that surprised a lot of people. It definitely surprises me. I don't know how you can rally the dollar when when you're just pumping liquidity in left and right. And I think the best way to explain it is we're the best of the worst. This argument's been around for a long time, but the U.S. is a store of value relative to other currencies and other economies. And so when things get kind of shaky and dicey in other places, they come here. So you look at energies, natural gas is spiking, oil's high. You look at inflation, which we all know is here, even though the Fed says it isn't. You just look at all these factors and you're like, wow, how can I possibly make heads or tails of this? Because you get a day like yesterday and, the grains, which should be trading their own fundamentals, get drug into this larger sell-off, right? But here's the deal. Even with all of that, the charts don't lie. Price action is king, and the total global wisdom is being digested and priced in right before our eyes on these charts. So even with all the noise, even with all the chatter and the clatter, we can come back to these charts and see it digested, right? We can see what's happening. So I've got your corn chart up here, and we've got South America, you got China that's behind, you've got all this stuff, and corn's not really doing anything. In fact, it's breaking out to the upside. So we talked about this last week. This is last Wednesday right here. This up day, we talked about how the daily chart and the weekly chart were not in line, right? We talked about how the daily chart had broken down below and looked like it might be ready to roll over, but the weekly chart was holding support and looked really strong. Well, and our conclusion for the last few weeks has been, hey, we're going to defer to the weekly chart because it's the long-term vision and it's the long-term goal, and it doesn't lie to us. So far that's working, right? The longer term chart is still bullish, and now this shorter term chart is even more bullish as well. We need to see corn pop up into this 559 area here, and there's obvious reasons for that. One, this is the massive key reversal that happened on August 30th. where we tried to break out, reversed it, and started this move to the downside. Second, this is the top of this resistance and congestion zone that contained corn for weeks. Yesterday, where did we reverse? Even with all the noise, technically it makes perfect sense. We rallied to the bottom side of the congestion zone and reversed from it. So is that the top? I don't think so. I think we're going to test it a little bit more. And I think the macros are starting to support that argument too. So, there's too much noise to look anywhere other than to price action to decide what to do. And with where we're at on the weekly chart, let me pull that up here. All right, with where we're at on the weekly chart, this looks really good. We've held our fib retracements. We're above where we were 26 weeks ago. We're starting to tweak higher. We're starting to take out prior week's highs. And if we can sneak up above 560, then corn can really get rocking and rolling. I don't know what the catalyst is going to be to get it there. And I don't care what the catalyst is going to be to get it there. That's what the charts are telling us. And until they tell us something different, we're going to stick to that story. All right. With corn, can it happen? Look at cotton. Cotton exploded the last week and a half. What's driving it? I don't know. But you can see a move like that happening in corn without too much impetus from where we're at. So, all right, beans. Beans, kind of the same thing as corn. We're just consolidating. We're getting banged around. The news is so bearish around beans. And everyone says, oh, the demand's not there. Nothing's there. China's not going to buy. Brazil's going to plant a huge crop. They're going to harvest a huge crop. And our yield is going to beat the USDA expectations. Well, then, guys, why have we not even tested the 38.2% retracement when corn tested the 50%? We've talked about this for several weeks. Yes, it looks kind of stinky on the daily chart, but there's nothing wrong with this weekly. So we got to continue to defer to it until we break this line below price action. What is this? This is where we were 26 weeks ago. As long as we are holding above here, this should act as support, and we should find some strength moving in. I have no idea what the catalyst will be, but that's what that chart's telling us. If we do tweak and or start to peak below it, and we start to work inside this weekly cloud, we'll have to revisit and rethink and see what's going on there. But it could be that beans just need to come down and actually test the 38.2% retracement, or even the 50 before they turn around and go higher. Remember, in trend analysis, this is nothing more than a pullback in this long uptrend, and it needs to correct both in time and in price to be consistent, and it's still all within those parameters. So I don't all the news, all the stuff, all the bearishness, I'm not really buying it because price isn't going with it at all. All right, wheat. Wheat, we still really like wheat. Where's my wheat chart? There it is. Still really like wheat. Even yesterday with the big sell-off, wheat got hit the hardest. Why did it sell off? Well, because everything sold off, and wheat, everyone loves to kill wheat. It's the most fun thing to sell, right? What's the story? Sell wheat, live in a mansion, and certainly that was the case yesterday. I think wheat's going to turn back around and push 730, especially if corn works higher. Those two are going to move in concert, and I don't see anything that would change our opinion on the wheat chart. The weekly chart looks good as well. I expect wheat to keep working higher, and until we see some real damage to these weekly charts, we're going to keep hammering that piece. Okay, I know that was a lot, really, really fast, but I wanted to condense it down to 10 minutes so that we can turn it over to Kevin. So I'm going to unmute you, Kevin. There you are, and I'm just going to turn it over to you. And I don't know if you want me to give you control or if I can just put your margin protection spreadsheet up on the screen so they can see it, and whatever you want to do here.
Yeah, okay, appreciate it, Tim. Good morning, everyone. Just want to introduce myself shortly. I'll try not to be long-winded. Some folks tell me that I can get long-winded when I start talking about crop insurance, but Tim and I share a mutual client, and that's how our paths crossed. I just first spoke to Tim yesterday, so we've got a new relationship here going. I feel like margin protection is the topic of the day. I'm in my truck right now. I'm traveling around, meeting with producers in their combines at this time of the year, renewing our wheat policies and talking margin, renewing some margin protection policies. Margin protection is what I want to speak to you all today about. This is a relatively new crop insurance program. It came to being in 2018. 2008 Farm Bill created this policy. Until now, it's been kind of boring, to be quite honest, because we've kind of been flat in all of our commodity prices. We haven't had a lot of volatility the last 4 years. Everything's changed now, as we know. And the unique part of this policy, Tim's already talked about it, is the input protection side that we have within this policy. This is a county-based program. For those of you, I'm sure everyone has some good familiarity with crop insurance. This particular program is county-based. What's that mean? That means we're not using your own production history on the farm. We're using the county, and that information comes direct from RMA. We're not using some sort of NAS yield anymore that surveys take. We're actually using your production history that you turn into RMA. So our county numbers are a lot more accurate than they were, say, 10 years ago. So it's a county-based program. We use 3 factors. And this is the thing you need to focus in on. We use our expected yield for the county, not your average. We use the expected yield. We use the commodity price. I'm going to keep my comments to corn. And then we use several input prices from DAP, potash, urea, diesel fuel, even interest rates are figured in as input cost for your production ag acre. Now, in the best form that I can without getting down into the weeds, I want to do an example. And I'm on my phone, and I'm familiar with what Tim has up on the screen. If you can see this, this is one of the tools I use to help show how this policy functions. I'm not going to get down in those weeds for this conversation now, but I will use some of the numbers that are on here. I've got Edwards County, Kansas, as an example. And let's talk about that expected yield for irrigated corn in Edwards. For 2022, it's 204.4 bushel. Now, let's talk about corn price. If everyone's familiar with how we discover our corn price for our RP policies that we're using on the farm, we have a discovery period. That discovery period is already passed for margin protection. It ended 10 days ago, and our price for corn moving into 2022 is $5.06. So we've got a 204 bushel expected yield, and we know we're already going into 22 that we've locked in for a floor, our 506. So we're going to be able to show what our expected revenue is going to be in the county. For example, it's going to be $1,034, our expected revenue. Now, this is a margin protection. So what is margin? Margin is our revenue generated per acre minus our cost. Everyone is aware of that. So that margin is what we're protecting with this policy. So our generated revenue is $1,034 for Edwards County under this example. Well, it's not an example, it's real world. And we've got a cost of $423. That's our input cost. Everybody's going to say, well, that's awful low. It is. That's just what we're using for our commodity, our diesel fuel, interest rate, urea, potash, and DAP. And then we've got some fixed in there for machinery, some labor, but our cost for this policy in Edwards for 2022 is $423, giving us a margin of $611. Then we've got a 5% deductible here. So we're breaking down to our trigger. We're protecting $560 of margin. Now that's really quick, and I'm not finished. What I want to do is back up and really break this down and what are we protecting and why would someone be interested in this product. In April 2022, we're going to have another discovery period for our inputs. So we're going to look in April, the whole month of April, we're going to average all these inputs I noted and come up with another look at our inputs. So if we go higher with our inputs between now and April, this is going to make this policy trigger a claim much, much faster. Now, we're not going to know in April if it's going to trigger a claim because we got to go to the production year. And like our RP policies, we're going to look at corn price in October of 2022 again to discover what our harvest price is. And at this point, I would ask everyone to consider, because this is a marketing call, I'm sure everyone's got an opinion. For corn for 2022, when we look out 13 months from today, are we bullish? Are we bearish around a $5 and change corn price? Everybody's got an opinion. Some are, some bulls, some bears, all over the board. I would say if you're bearish and if you're emphatic about that, I think margin protection is something that you really need to understand and possibly use for this next crop year, because we're able to protect in Edwards County, for example, 95% of 204. So that, if you do the math in your head real quick, and I kind of have and cheated a little, it's 194 bushels at $5.06. But this gives you a subsidized put. This product, margin protection, will give you a subsidized put. What do I mean subsidized? The premium that the producer pays for this policy is subsidized by the federal government to the tune of 52%, just like most all the other insurance products that we have in the crop insurance world. So we're able to protect 194 bushel to the acre at $5.06 in Edwards County for, let's say, 20 cents a bushel. It might be a few tenths short, it might be 19.5. There's some variances on what that cost would be, but let's call it 20 cents for a 506 put on 194 bushels of the acre irrigated corn. And then we factor in the cost of production that we have to protect too at this point. So that's very high level at what we have in front of us today for margin protection. Tim and I crossed paths real recently as I'm out and about, informing producers, renewing clients, meeting new folks. We're kind of up against a wall for 2022. As you all know, your wheat policies are renewing here tomorrow. The 30th of September is our last day to renew our 2022 wheat or buy new policies. Same for margin protection. We're closing in on our deadline for 2022. Everything needs to be locked up and tidied up by the end of business tomorrow. The reason I'm on the line here is just to try to bring value. Day in, day out, I'm a crop insurance agent only. My agency doesn't sell anything but crop insurance. We live and breathe it 365 days a year. So every day my goal is to bring value, and I love it when I can meet new folks. Production agriculture is my passion. And when Tim and I got together here and visited yesterday, he invited me on this call to talk to you all. And I just appreciate the time. Here's what I'm going to put out there. I'm going to give you my number, and you can reach out to me anytime. 217-257-5961, and it's Kevin Cantrell. And I'm sure you can text Tim if you are not in a place where you can write that down, and he could give you my contact information. This isn't a hard pitch. I'm just here to help. I've got producers across Kansas. Actually, I've got producers in, I don't know, right now I'm up to 6-7 states now, I think, but I move around quite a bit. And if you've got any questions around margin protection and how we can protect our inputs going into this volatile year ahead of us, and understanding a little better how margin protection functions on the yield and on the price side, feel free to reach out. It's not too late to get involved with this. Like I said, we've got until the end of next week, or end of business tomorrow, and we can process this. And I just want to take that opportunity to share. And if there's any questions, I don't know, Tim, if you open up the lines at all, that might get a little bit hairy, but you can get to me 24/7. I'm on the clock. If you're working, I'm working, is what I always say. Again, that's 217-257-5961. And Tim, I'll limit it at that. And there's a lot I could talk about this program and what it can do and offer for an hour probably, but I'll just limit it there, trying to whet your appetite to see if there might be interest out there.
And Kevin, I can't tell you how grateful I am that you did call, because I think it's really innovative, and I wish I had known about it, before. But what's fascinating is that there's so much uncertainty, and the case that we've been making for weeks is that the ingredients exist to create massive volatility, and we don't know which way they're going to go yet. And so figuring out how you're going to manage downside risk is really pretty easy in the corn market, but how you're going to manage the risk of higher inputs is much more difficult. And so that's really an attractive policy. So what we'll do is I'll include your information in the video link when we send this out. I'll just attach that here. And by all means, like Kevin said, we met yesterday, so this is purely information for you, for everybody. I think it's in everyone's best interest to know it exists, which is why I was excited to share it. And I hope it drives a lot of business for you. So, and if not by tomorrow, I hope in the future it does. Nothing would make us happier. So,
great. Well, Tim, we can talk offline at another time. If there's any questions generated from this call and this conversation that you get that you need, anything at all, feel free, call me, text me, email me any time of day. And moving forward, maybe you and I can visit a little more about what might be possible.
Sure. Sounds great. All right, everybody, we try to honor that 20-minute commitment. I know everyone's busy, and I don't want to take any more time than we ever asked for. So I'm going to wrap that up. In summary, I see no reason to make a change on our marketing plan based on price action. And if that changes tomorrow, there is a stocks report tomorrow. I think that'll bring some volatility, but I don't think it'll be as explosive as some of the other reports we've had. So we'll, if something happens, we'll let you know quickly, and as always, we'll take action if need be. Remember, there's always significant risk in trading futures and options, and if you're going to trade them, do so in light of your own financial condition and work with a professional as they go. We're here to answer questions, and I hope you guys have a great week. We will talk to you next Wednesday.